Good morning, everyone, and thank you for joining us for our China Q2 update for 2021. We're joined today by Tian and Liang, who are based in our offices in Shanghai, and we're going to be discussing, the three China funds that you make use of, the feeder and the UCITS China Balance and Equity range. And I'm just going to hand over to him straight away. And what we're essentially going to be looking at is, what sort of global, what we're seeing relationship-wise between the US and China, and how the infrastructure boom is really coming through in China, and then looking at the different ways that you can access China through the MSCI China and the CSR 300, and finally wrapping up with the current fund positioning. So over to you, Tian and Liang.
Thanks very much, Jason. Morning, everyone. Thanks for your time this morning. Thanks for joining us. Look forward to updating everyone. So I'm going to head straight into the presentation. Quite a lot of info in terms of China and global update. But firstly, sort of a vaccination progress update again. The chart, the famous Bloomberg COVID vaccination chart, going greener and greener, which is very positive. We can see that the developed nations, Western Europe, North America, China, Japan, South Korea, all looking very green. South Africa is slowly catching up. Vaccine supply very, very limited. If we look at mainland China dominating total doses administered at over 1.3 billion doses administered to date as of this morning. That's enough coverage for 48% of the population. So the magic number we're looking for mainland China is probably closer to 2 billion before the government will be more willing to open up borders. So I think that's probably percentage-wise 60 to 70% everywhere across the world. We can see China, EU, and the US now all hovering around that 50% mark, which is very encouraging, and we're hopeful that these numbers will increase, allowing global economies to open up. There's talks of additional variants, or there are additional variants of COVID, and talks of additional doses to strengthen immunity, but overall vaccination progress is positive. Moving on to specific China-US relations. During our last webinar, we talked about China and the US having a public spat in Alaska in their first meeting since President Joe Biden took office. This quarter, a lot of developments actually, and we see it as positive. So probably difficult to see it in conventional media, but firstly, I think the chief negotiators on both sides spoke. So Chinese Vice Premier Liu and the US Chief Trade Representative Catherine Tai spoke over the phone. The call took place late in May between the two chief negotiators, and the official communication has been that both sides agreed on the importance of bilateral trade. They also discussed areas of mutual interest and agreed to maintain communications. We expect the Biden administration to build on the phase one trade deal reached under the Trump administration. Further on, more positive developments we feel. Again, Vice Premier Liu talking to the US Treasury Secretary Janet Yellen. Again, not too much detail released to the public, but official communication communicated from both sides that, again, agreement that bilateral economic relations are very, very important. Bilateral and multilateral cooperation globally is very important. And both sides mentioned that the talks were candid or frank and agreed to continue to communicate. Again, a significant step in our view from the silence towards the late Trump administration era. So we see that as positive. Some more, I guess, not so positive pointers to mention is that the tech war and selective bilateral sanctions remain. Most notable, obviously, Huawei as China's tech giant being very much sanctioned in terms of technology, microchip supply. But overall, from our side, in terms of your investments via Prescient China, very low investment portfolio impact as a South African investor. We think other positive developments, such as more bilateral dialogue between Yang Jiechi, who is the previous Chinese ambassador to the US many years ago and currently a top diplomat here in China, speaking to Antony Blinken, the current Secretary of State. Both mentioned that they had beneficial contact. On the commerce side, Wang Wentao, who's the current Minister of Commerce, speaking to Gina Raimondo, current Secretary of Commerce, and agreed on pragmatic cooperation. So overall, we feel Western media tone on China is still very much negative, but as we mentioned always, it is very important to filter through the sensational noise that we see in the media and focus on actual hard data and actual significant progress. We feel that tangible progress between both sides will always be reached behind closed doors. So as members of the public, we probably won't see too much detail of that, and we feel that's a positive development. What's important is that both sides are talking, and that creates more understanding, and overall we believe tensions are beginning to ease. And as domestic political pressures ease on both sides going through over time, we expect further positive developments between China and the US. So overall, a positive quarter of developments on the political front. Moving on to China, what we thought we'd cover this quarter, something of interest, is that China is often dubbed domestically within China by citizens or netizens, as they call it here, because of the vast number of internet users in China. It's often dubbed the king of infrastructure, and we thought we'd take you through some major infrastructure projects that will be completed, currently underway, and will be completed most likely in the next 5-year plan ending 2025, so from 2021 to 2025, and what we can expect in terms of Chinese economic development, at least on the infrastructure side. Firstly, overall projects planned, there are many projects, so we're only going to cover some of the flagship projects, but overall, about 24,500 infrastructure projects planned nationally over the next 5-year plan, and some extending even further. Total budget estimated at around $7 trillion US, with about 25% expected to be spent on transportation-related spending, which is typically the largest single sector spend in terms of infrastructure. Just to give everyone an idea, the 7 trillion infrastructure budget is about 23 times South Africa's annual GDP output. That GDP number is obviously a depressed 2020 number, but nevertheless, it just gives one an idea of the scale of China's economy, especially China's infrastructure spend, only representing a portion of China's economy. Moving on to actual projects, the biggest, the main flagship project is probably the Greater Bay Transportation Network projects. So it includes a lot of expressways, high-speed railways, bridges, tunnels, etc. It covers a range of Tier 1, Tier 2, and Tier 3 cities in the southern region of China, near Hong Kong, Macau, Shenzhen, Guangzhou area. Those are the Tier 1 cities. In the area, population coverage of about 70 million, so bigger than the entire nation of South Africa. So major transportation network. If you look at a map, it's probably not too easy to see, but the map covers many cities. So it covers Hong Kong, Macau, covers about 7 major metropolitan areas. The entire transportation network covers high-speed intercity railway links, intra-city metro networks, airport upgrades, bridges over the ocean. You can see the ocean area. Overall planned budget for the entire project is about $74 billion. So just to give everyone an idea of the size of the map, although it doesn't look very big, and you can see there are many major airports. So about seven major airports in the region in total, with the top 4 airports, Hong Kong, Shenzhen, Canton, Guangdong, and Macau, covering more than 200 million passengers annually. Obviously, that's pre-COVID figures, but once COVID is over, the entire area probably covering between 250 million just in terms of airport transportation, between 250 million to 300 million passengers annually. Looking at one of the flagship single projects in the area in this transportation network is the Hong Kong-Zhuhai-Macau Bridge. It is the world's longest sea crossing. Some pictures showing the bridge going over the ocean and tunnels going under ocean. It's probably one of the major architectural achievements of China over the past couple of years. It was completed a couple of years ago as the flagship transportation project in the area. Moving on to further infrastructure, this time an entire new smart and green city of the future. So it is a new district called Xiong'an District. It is about 100 kilometers southwest of the capital city, Beijing. and about 50 kilometers to the new Beijing Daxing International Airport that will slowly take over the airport, the main airport functionality from the Beijing capital city international airport currently. It is a new 5G city, a city that will allow self-driving. The main driver for the city is that a lot of Beijing municipal government functions will move to the area once it is built. Look at these photos. We showed these photos last year sometime, but it's always interesting to see it again. Basically, this is one of the infrastructure projects that have been pushed forward to stimulate the economy post-COVID last year. So effectively, part of this new district or city is 160,000 plus workers working on around 120 big and small infrastructure projects within the area 24/7, 3 shifts of 8 hours, building non-stop. And one of the major achievements that it has achieved is the opening of the high-speed rail station, the Shanghai high-speed railway station at the end of last year. So the picture probably doesn't do it justice. It is a major transportation hub connecting itself to Beijing, the capital city, and the neighboring Hebei province. So the size, to give everyone an idea, is about 66 football fields or 66 soccer fields. So that gives one an idea of the landmass. And the cost of this high-speed rail station, including the network connecting to surrounding province, is about $13.5 billion US. After we look at all the concrete stuff of Shanghai, the Chinese government also very focused on greenery and going green, with President Xi committing for the country to become carbon neutral by 2060. Shanghai is obviously going to be a flagship example of how the Chinese government plans to keep the country green. So by the end of 2020, about 27,000 hectares of land in Shanghai was covered in greenery. So a couple of photos on this slide showing sort of the green lifestyle that new residents of Shanghai can experience. And the planned greenery is about 70% of Shanghai. So all the concrete jungle that we saw earlier is only going to take up 30% of the entire city. So it's going to be a very livable, very green, including smart new technology and overall a smart green new city of the future as planned, as mentioned. So, that gives, I think, 2 of the main flagship projects of China. Gives everyone an idea of what to expect. Many more of these projects will follow in the 5-year plans to come by the central government, and we are quite excited to see these developments come through. Sitting in Shanghai, we felt definitely a lot of environmental improvements. Shanghai is already a concrete jungle, but a lot of environmental improvements, for example, air quality and water quality improvements, and we are optimistic. We believe this is a major and positive development in China. Okay, moving on, I think this quarter specifically, we mentioned this previously in our webinars and client communications. We wanted to go emphasize again the difference between the 2 major China indices, ways one can access China. MSCI China versus CSI 300. So Prescient has obviously decided to go with the CSI 300 mainland Chinese benchmark index, whereas many Western managers access MSCI China due to the ease of access. But we'll show you why Prescient has decided to go with CSI 300 as a better representative of the Chinese economy. So if we look at the top 10 holdings of MSCI China in the table on the left, you can see that it is very much dominated by technology stocks and finance stocks. Top 10 stocks also making up a whopping 45% of the index. So the top 10 stocks making up almost half the index. So we believe the MSCI China, although very easily accessible, although the companies are great companies themselves, we feel there's a lot of concentration, both in terms of single counter stocks and also in terms of sector concentration. Whereas if we look at CSI 300 on the right-hand side, the top 10 stocks also only making up about a quarter of the index. And if we look at the top 10, it's a much more even spread. We see liquor companies, we see insurance companies, we see green energy companies, consumer electronics, pharmaceuticals, etc., etc. So we see CSI 300 as a much more diversified index of 300 stocks and a much better representation of the Chinese economy. I think one of the difficulties of many Western managers is that they do not have the QFII investor license that Prescient has that allows us free access into mainland China and out. So effectively, as Prescient, we do not have the capital control restrictions that many other Western or South African asset managers will have investing into China. So we are able to choose the CSI 300. Moving on, historically, as a South African investor, CSI 300 has provided probably the best diversification benefit amongst the global indices. So if we look at the bar chart on the left, we can see CSI 300 offering a much lower correlation to the JSE index. If we look at the chart on the right, if we compare CSI 300 correlation and MSCI China correlation, both to the JSE All Share, historically, if we look at long-term correlations, the CSI 300 with an average of under 30% correlation to the JSE, whereas MSCI China was reaching 60% on average, and at its peak, 70% correlated to the JSE. So again, showing CSI 300 being a much better diversifier to control your risk in your overall global portfolio as a South African investor. Looking at returns, we thought it was quite interesting. Historically, if we go back a very long time, probably since 2005, returns between CSI 300 and MSCI China weren't that different. But over the past 3 years, we started to see a diversion. So if we look on a 3-year basis, if we look at US dollar returns, the CSI 300 has outperformed the MSCI China by around 7% per annum. If we look at the 1-year figure and just for quarter 2 2021, CSI 300 consistently outperformed. So this is not to say that the CSI 300 will always outperform, but given its diversification benefits, given our view that Prescient's view that CSI 300 is a better representation of the Chinese economy, so overall we feel, given the divergence of returns, just the return factor is again another factor to consider, especially as a South African investor. Yeah, so I think that's it from me. With this, I'm going to hand over to Liang to take us through current sort of market valuation, portfolio positioning.
Thank you, Tian. I think to kick off with just a quick update, at the end of June 2021, China and Hong Kong remains one of the cheapest markets in the world. So you compare with emerging Asia, India, US, Taiwan, etc., you'll find that China is still one of the cheapest markets in the world. It is not cheap relative to its own history. Don't get me wrong, every single market in the world has been boosted by massive amounts of money printing. Everyone's PE ratio are ridiculously high, but just in this crazy world, China looks a little bit more reasonable. And even off these elevated valuations per history, China's one of the few markets in the world where you can still expect some real returns over the cycle, although one has to be quite realistic as to how much real return you can get. I think the history of doing inflation plus 10, 11, 12, I think that's past. Wait till the next correction before that's possible again from these levels. However, it still remains one of the cheapest markets in the world. So if you have to deploy your money somewhere, then China still looks very, very attractive. Taking a step further, as we mentioned, I mean, you guys know we're involved in Hong Kong. Hong Kong share market currently, I can say, is pretty much the cheapest share market in the world. There's absolutely nothing cheaper than stocks in Hong Kong. For us, we buy a lot of stocks that are in our mainland A-share benchmark. They have all their operations in mainland China, not in Hong Kong, not in the rest of the world. The fundamentals of their business are great. They're trading at half the price they're trading at in mainland China. And basically, we're buying fantastic companies at a PE of 6 or 7 versus a PE of 12 to 15 in mainland China. And we happily hold that in a diversified portfolio, not taking any more risk relative to our benchmark. Over the long term. And we think that's very attractive. When that corrects, we're going to get another 2 to 3% alpha on the entire fund on a small allocation. Right. Shown this chart before. We historically bought futures in China, and basically when the discount gets quite large, we buy futures. As we sit right here at the start of July, the discount actually almost completely closed. So historically, we bought a lot of futures. They paid off quite well for us. But as we speak right now, that opportunity has closed. And we'll continue to monitor, and when the opportunity comes again, we'll take advantage of it again. Over the last since the first quarter this year, we've been talking about mania stocks, and essentially what they are is just a bunch of stocks that since the coronavirus occurred has gone absolutely crazy. So one of the examples we've shown was SF Holdings. So SF Holdings is one of the best logistics and delivery companies in mainland China. However, in end of January this year, it was trading at a PE of 70, price to book of 7 times. It rallied 155% in 12 months. And since then, in the last 3 months, the correction has been 45%. It was held by pretty much all active managers. There's no doubt it's a good company. It's a very, very good company. But should good companies trade at infinite valuations? So by the end of Jan, that P was already 70. Now, currently, after the 45% correction, the P is still 50. Right, so it's still very, very high. And what we're seeing is that there's a whole bunch of stocks like this in the market. Pretty much 70 to 100 of them that's held by all active managers or in a concentrated portfolio. But for us, by avoiding all of those, we're more or less sector neutral, nothing too exciting in terms of sectors. Avoiding all of those, for the first 6 months of this year, we already have 2.56 alpha. So it also speaks to our risk control. When they were rallying massively from December to February, we pretty much kept pace with the market in terms of our equity portfolio. We had no different. And as they fell away, we start getting more and more alpha. And that's exactly the key to our process, is that you have this risk diversified process where you're not betting on 1 or 2 things. You're not worried about is there a regulatory clamp down on Tencent. You're not worried about what's happening with regulators in Alibaba, etc., etc., etc. On a diversified portfolio, buy cheaper, high quality, lower volatility stocks over the long term. And that's been very, very successful for us. And alpha is coming through very, very nicely this year. Looking longer term, same story. Last 12 months, our alpha is about +3, and since inception, it's also about 2.5 to 3%, all net of fees. And when we compare ourselves to the largest ETFs in the world on the CSI 300, we outperform them by an extra 1% because of their fees and costs, etc., etc. So after all costs, everything, we outperformed them by about 4% annualized, and last year we outperformed them by about 5%. Looking to the balance side on asset allocation, you guys know that for years we've been very, very overweight equities. We look at 60 to 90% equities, and since about January, February this year, we've actually changed. So what driven that change is twofold. Number one, on the economic side, we've seen that the economy is still strong, but slightly cooling down, and number two, inflation is likely to pick up. So that combination gave us a little bit of pause. And secondly, is that valuation has increased a lot. So where we're 60 to 90 equities, Chinese equity market PEs are typically between 9 to 12, right? And currently we're sitting at around 18. Now, with so much money in the world, who knows what could happen? You could easily have a blow off based on just massive liquidity, and vice versa. You could have a situation where global economies, the rebound has occurred. It's actually not that strong around the world after the rebound. The stimulus is starting to come back. We're starting to see the earlier sign of inflation around the world. And that's why currently we're sitting at around 65% equities. And actually, as of today, we're already down to 55% equities. And that's where we see, right? You have to be very, very active in this market environment. Don't be scared to overweight and underweight, depending on what's happening in the market, and be on the ground looking out for this. And that's what we've been doing. In terms of performance, not too exciting. Year to date, we're up about 3%. In the last 12 months, we're up 34%. And since inception, we're about 11.5 or 12% net of fees, outperforming 65, 35 by a wide margin. I think we continue to be the case. I think over the past year, performance has been ridiculously strong out of the coronavirus for almost all markets around the world. That's not something you can expect over the very, very long term. So for the long term, we think we have to be more realistic in our expectations. Having said that, we still think that opportunities in China is really good. The valuations are okay. You can still get a reasonable outcome investing in China. And on top of that, following our well thought out long-term process, we believe we can add alpha over the cycle. And by doing that, we should be doing quite well over the next cycle too. In terms of peer rankings, compared to funds around the world, 1 year, 3 year, 5 year, on dynamic allocation funds, we're still easily in the top 10 percentile across all longer term time periods. And we're quite comfortable. We believe in our process, and over the cycle, it is what we expect. So I'm going to stop pretty much there, and I'm opening up for questions, given that I've just opened up to the floor for some questions. So if there's any questions, please let us know, and I think Jason will pass it on to us.
Perfect. Thank you very much, Tian and Liang. I'm just going to start jumping into questions, and if you do have any other questions, please use the Q&A functionality and shoot them through to us. So I'm just going to start here with recently BlackRock mentioned, well, I saw them earlier this week, and they made mention about how China's should not be looked as part of this EM basket anymore, and how it's actually a growth, a geographic location in its own right. What are your views, and can you maybe elaborate on what they were saying?
Sure. I think for a very, very long time, we've been making that argument. So we've been making that argument over the past 3 to 5 years. And it's one of the reasons why we started the China Fund and took the entire team to China in the first place, is that we think they're exactly right. I think China as a country is the second biggest economy in the world. If all goes smoothly, probably will be the biggest economy in the world within the next decade. So that's something that we can expect to happen, right? That combined with a huge capital market, combined with monetary and fiscal policy that's independent to other emerging markets. China is not emerging market in the typical sense of creating, let's say, creating commodities. China is a market that actually takes raw materials and make end products, right? So for all of those reasons, when you put it together, and the fact that over the long term, the capital market will open up, we definitely agree with their assessment that that's the case.
Great, thank you. And then maybe stemming on from that, so I mean, I'm playing a bit of a devil's advocate as an advisor. I've decided, I want to allocate to China, and I'm looking at introducing China to my, current mix of portfolios. How do you, we've also argued in the past that MSCI World is underweight China. So how much should I be allocating to, bring that back to what we would consider the right, correct allocation level?
Well, that's such a tough question, Jason, because there's a mathematical answer and there's a practical answer. So the mathematical answer is that number, let's say the US is something like 50% in your portfolio, then China should be the next 30. That's a mathematical answer. But realistically, we don't expect anyone who will be brave enough to do that, even though it's the right answer. So a more practical answer is probably somewhere around 5 to 10%, where you can still get the benefits of diversification, still get a good boost to your return, but not being affected too bad by being too far away from everyone else.
Great. And then before I get into the actual technical questions on China, I've got some more coming through here about, the balance fund and asset exposure. Could you maybe explain the dynamic of it's not the generic balance fund, it's a very flexible mandate that we manage, and how we can, move in and out as we deem, correct at the current market?
Absolutely. So I think there's quite a few things. In terms of us, the way we see it is actually very, very simple. When the market is cheap, sentiment's on your side and policy supportive, you want to be max equity, right? So we allow ourselves to be 90% equity in that example. And vice versa, when the market's really expensive and the policy is not so helpful, at the same time, you're going to see, and inflation is coming up, monetary policy is tightening, you want to be very, very negative. Sentiment will be very down, so we're 10 to 40% equities. So we have full flexibility going from 10% all the way to 90% of asset allocation. And currently, right this second, we're sitting at around 55% equities in our balance fund. Slightly lower than our long-term average of 65, and that can change as new data comes through.
Perfect. And just getting a bit more technical here. So there's a question that's come through. Backward-looking data suggests that China is not experiencing a sharp slowdown, but forward-looking indicators suggest growth momentum will fall off a cliff. Do we agree with this assessment? Council announced earlier this week that they could consider more reserve ratio relaxation, liquidity injections. Does this suggest the start of a new easing cycle, or just a fine-tuning sort of policy?
Great question. So I think falling off a cliff is a bit of a dramatic phrase. So I think, if we take a look and we think about it, what's happening is that as every economy in the world, as we came out of 2020's coronavirus epidemic, we're at a low base effect. So China was growing at 9 or 10%, right? So if you think about long-term China, that's not China's growth rate. China's growth rate is 6%, slowing down to 4% and lower over the next decade. So naturally, the number you should be looking for China, especially given that China's already, the GDP is higher than it was pre-pandemic, with half the world not yet open, is that naturally the economy is going to slow down from what we've seen last time. So that's the first thing. So naturally, the economy is going to slow down. As you mentioned, they're tweaking their policy on the edge. And I think every government, just like us, an asset manager, is sitting around looking at the same data. All right, you have this inflation coming through. Forward-looking inflation looks a little bit better. You're hoping that this is transitionary, so you can ease a little bit. You can see that growth is starting to top out and come down, and China's perhaps on the earliest phase of that. That's because we came out of the growth phase at the earliest. I think in terms of China policy making, it's been very mature over the last 5 or 10 years. So the cycle, like I said, ever since President Xi Jinping came over in 2012, certainly we see a maturity in our policy making in mainland China. China's a very, very big country. So we're not trying to jump from one extreme of super loose, easy monetary policy to super tight, right? So US situation now, growth is slowing slightly. Interest rates are reasonably high compared to the rest of the world. You're looking at 2.5% to 3% interest rates compared to 0 around the world. So they are on the edges, small things that they want to do. And one of the things they really, really want to do is to take money away from the asset market. So what's happening, like the rest of the world, you have house price inflation, you have stock market inflation, you have commodity inflation, right? So you want to take money away from those places and fine-tune them and put it into the real economy. And I think that's the challenge that the Chinese policymakers really deal with, and they're trying to get that right at the moment. So exactly like you said, our data suggests the same thing. There's an obvious slowdown coming on that, but it's nothing to be too alarmed about. On that side, to us, it just looks like the hyper growth rate we've seen, the 8-9% coming out of the low base in 2020, is going to normalize back to around 5 to 6%, which is normal for China.
Great, thank you. And I'm gonna. There's a few questions coming through with the same sort of theme, so I'm gonna try to group them a bit together. And it's more around Chinese regulators clamping down on dual listings and how they there's rumors of regulation on oil pricing and commodities pricing. And I suppose one can also bring it back. What we see from outside of China is the regulation on technology and the growth of those sort of stocks and companies. How is that managed, or what has been done to kind of open up the world of technology to the rest of the world?
Very, very good question. I think we've also tackled this before, and we always said big tech in the world is getting too powerful around the world, and they're extracting monopoly profits like everyone else. It is not a good thing when the biggest tech companies in the world owns everything, right? So they buy every startup, they control all the channels to market, and they can extract a very high cost to all corporates. So you've seen cases like gaming companies in the West fighting Apple, etc., etc., etc. All of those examples are popping through. And the only regulator in the world that has actually done something about it is a Chinese regulator. So I think that's more what's happening in the Chinese regulatory tech space. I think it's very, very clear to us that Chinese regulators are identified that you do not want a market dominated by a few monopolies. That is the last thing you want. So as such, you have to delve in and see what are the anti-competitive behaviors they're doing and stopping that from happening. The second thing is, on the regulatory side is also, because they control so much data, right? So these big companies control so much data. And if you think about where is the competitiveness or what you can do with this data, right? So what's the scariest thing about social media? Right? It's not that we all go look at photos and waste some time. That's not scary at all. The scary thing is with so much data in their power, they can target things to you that will over time change your mind, right? Over time change the way you think about the world, your beliefs, your things. They do it very subtly over a very, very long period of time. And I think that's where the regulator also is clamping down. So on DD, for example, is what's happening to this data? How are you using the data? How are you protecting the data from being breached? We've had data breaches all around the world. So that's what we're seeing mostly on the IT sector on the regulatory side. Right. Once again, as we mentioned before, our process stops us from trying to guess that. Right. So who knows what's going to happen? I think what's reasonably clear is that, given that there is a target on that, especially kind of sentiment on the Chinese market, is that the hyper earnings growth will have to be earned. They have to come up with amazing things. They're not going to have this hyper growth because they're going to anti-competitive things by being a monopoly in China. So I think that's quite clear.
Great, thanks very much. And then I think this is probably our last question for today, and I think it's quite a nice way to wrap it up. We spoke about how MSCI versus CSI 300, slight differentiation here. Someone's asking about how top 10 holdings, are they all A and H shares, and are those shares actually regularly available outside of China, or are they only traded within China?
So the vast majority of our shares in our top 10 are almost all A shares. So they are almost exclusively available in mainland China and not easily accessible outside of China. So the big sectors that go outside of China, essentially the tech sector, is the one sector that's ridiculously popular overseas, and they tend to IPO overseas. They're very, very good companies, even now today, right? Alibaba and everything is looking quite attractive given how much they're corrected. So they're very, very good companies. But with that also, it comes with a lot of risk. As you guys seen on the regulatory side, there's regulatory risk. But furthermore, on the structure side, I think, so everyone understands the Tencent structure, the Naspers structure, right? So it's a VIE. Essentially what it is mainland shareholders own a company in mainland China, that is Tencent. Then in the BVI, you create another Tencent, and that Tencent has a bunch of contracts that moves all the profits into that. That's what it is. And historically, in the last 30 years, Chinese regulators have not stopped it, right? And nowadays, they're taking another look at it. I don't think they'll ever reverse it, but it's certainly possible that they'll stop allowing new companies to continue down this path. Essentially a regulatory loophole. So that's something worth considering on all of that.
Fantastic. Thank you very much, everyone, for your time today. And if you do have any more questions or comments or would like to reach out to us, please reach out to your respective consultant in your region. And until we chat again, keep safe and have a fantastic weekend.
Thank you, everyone.
Thanks, everyone.